All right, let's dive into a topic that is absolutely critical for your exams and, frankly, for your wallet. We're talking about inflation targeting. This is the government's master plan for keeping prices under control, and you better believe it affects everything, from your loan payments to the actual value of the money you've saved. So let's break down exactly how it all works.
Here's the game plan for today. First, we'll look at why India even needed this mission. Then, we'll meet the people who actually set the interest rates. After that, we're going to tackle two massive challenges they face, something called the impossible trilemma and the constant battle between debt and inflation. We'll give the whole framework a report card, and then, most importantly, wrap it all up with a super concentrated summary of key takeaways for your exams.
Okay, first things first. Why did India need this whole new game plan for prices? To get that, we've got to jump in our time machine and go back to the days before 2016, because the way things were done then, well, it was a completely different story. So think about it. Before 2016, how was the Reserve Bank of India, the RBI, actually trying to manage inflation? The truth is, they were using an approach that had them juggling way too many things at once, and it just ended up being confusing for everyone. This old system was called the multiple indicator approach. Just imagine the RBI trying to keep its eye on dozens of economic balls in the air all at the same time. Money supply, credit growth, global trade, you name it. The biggest problem? There was no single, clear goal. It was kind of like a ship trying to navigate a storm without a compass. This meant nobody could really predict what the RBI would do next, and it was almost impossible to see if they were even succeeding. And the cracks in this old approach really started to show between 2009 and 2013. India got slammed with a massive inflation crisis. We're talking about consumer prices shooting up by over 10%, the highest among all the G20 countries. That economic shock forced a rethink, leading to the creation of the Urjit Patel Committee. Their big, game-changing idea? Get rid of the old, confusing system and make controlling inflation the one and only primary target. And that recommendation, well, it led directly to a change in the law in 2016. And just like that, inflation targeting was born. So, what exactly is inflation targeting? It's a framework where the central bank has one main job, one clear mission: keep inflation at a specific, publicly announced target. Now for India, you absolutely have to remember these numbers. The target is 4% CPI inflation, and it's not rigid. There's a tolerance band of plus or minus 2%. That means, in simple terms, the goal is to keep inflation somewhere between 2 and 6%.
Okay, so now we know the mission, but who are the people actually in charge of carrying it out? Let's meet the team, the very powerful committee that decides India's interest rates, the Monetary Policy Committee, or MPC.
Yep, when you hear that loan rates are going up or down, these are the folks making that call. It's the 6-member Monetary Policy Committee, and their main weapon is the repo rate. Think of it as the interest rate at which the RBI lends money to other banks. By raising or lowering this rate, they try to steer the entire economy's inflation towards that magic 4% target.
Now, the structure of this committee is a classic exam question, so listen up. It's a team of 6, split right down the middle for balance. You've got 3 members who are insiders from the RBI, including the governor, and then you have 3 external experts who are appointed by the government. Here's a super easy way to remember it. Team RBI plus Team GOI equals Team MPC. Can't get much simpler than that.
So we have the mission and we have the team. But their job is way harder than it sounds, because of a fundamental puzzle in economics that's known as the impossible trilemma.
The impossible trilemma is basically one of the golden rules of international economics. It says that any country wants 3 things: control over its own monetary policy, a stable exchange rate, and capital flowing freely in and out. The only problem? It's impossible to have all 3 at the same time. You're forced to choose. You can only ever have 2.
You only get to pick 2. A really handy mnemonic for this, especially for your exams, is FIM. F for fixed exchange rate, I for independent monetary policy, and M for mobile capital. Every country has to look at these 3 and decide which 2 are the most important to them.
So which 2 did India pick? Well, officially India chose to have an open capital account, that's the M, and an independent monetary policy, the I. I mean, having an independent policy is the whole point of inflation targeting, right? So if you choose I and M, the trilemma says you have to give up on F. That means India must let its exchange rate be flexible.
But here's where things get really interesting. Take a look at this chart. It shows how much the Indian rupee's value has been bouncing around. Now look at that second bar. In the last year or so, that volatility has crashed to just 1.9%, a 30-year low.
Let me tell you, an exchange rate that's truly flexible and floating freely does not behave like this. This is a huge clue that the RBI is heavily managing the currency, trying to keep it stable.
And this intervention creates a massive problem. To keep the rupee stable against the dollar, the RBI has to go into the market and buy up US dollars. But when it does that, it has to release more rupees into our own economy to pay for them. And what happens when you have more rupees chasing the same amount of goods? You get inflation, the very thing the MPC is supposed to be fighting.
And if that wasn't complicated enough, there's another major conflict brewing. This one happens right inside the RBI, because it's forced to play two totally opposite roles at the very same time, managing the government's debt while also trying to crush inflation.
Think about it. On one side, as the country's central bank, the RBI's main job is to keep inflation low, and to do that, it often needs to raise interest rates. But on the other side, the RBI is also the government's banker. In that role, its goal is to help the government borrow money as cheaply as possible. You see the problem, right? Raising interest rates to fight inflation directly makes the government's borrowing more expensive. The RBI is being pulled in two different directions.
And hey, don't just take my word for it. This quote from the source material spells it out perfectly. There is a clear conflict of interest. For years, expert committees have said that India needs a separate agency just to manage government debt to solve this problem. But for now, the RBI is still stuck juggling both jobs.
Okay, so given these huge challenges, the impossible trilemma and the debt conflict, how has this whole inflation targeting thing actually performed in the real world? It's time to pull out the report card and see the grades.
The biggest win is right here on this chart. The numbers don't lie. Before inflation targeting, average inflation was a painful 7.26%. After it was introduced, that average fell all the way to 4.95%. So on its main goal, bringing down average inflation and keeping it stable, you have to say the framework has been a clear success.
But then, COVID-19 hit, and the whole framework was put under a massive stress test. And to deal with the crisis, the RBI had to bend the rules a lot. As you can see here, the main policy tool basically switched from the repo rate, which the whole MPC decides, to the reverse repo rate, which gave the governor more direct control. The whole system was rejigged, and a bunch of unconventional emergency measures were brought in. This period really showed the limits of the official framework in a crisis.
And that brings us to the first official on-the-record failure. In 2022, thanks to shocks from around the world, inflation in India stayed above that 6% upper red line for 3 quarters in a row. That automatically triggered a failure clause in the law, which forced the RBI to write a formal letter to the government explaining why they failed and what they were going to do to fix it.
Phew. Okay, we have covered a ton of ground. So let's boil it all down into the absolute must-know points for your revision. This is the stuff you absolutely need to remember.
Here it is, your entire explainer on one slide. Let's run through it. The framework is inflation targeting, or IT, and it was adopted in 2016. The mandate? Keep CPI inflation at 4% plus or minus 2%. The group in charge is the Monetary Policy Committee, or MPC, and their main tool is the repo rate. How's the MPC made up? 3 RBI members plus 3 government members. The 2 big challenges are the impossible trilemma and the debt management conflict. And the final report card? It successfully lowered average inflation, but did breach the 6% target back in 2022. This slide right here is pure gold for your revision.
And all of this brings us to the big final question. As India is aiming for really high economic growth, is having a system that is so strictly focused on inflation a good thing? Is it a catalyst that creates the stability we need for that growth? Or is it actually a constraint, something that sometimes holds our economy back from reaching its true potential? That, right there, is the central debate that's going to shape India's economic future.